My name is Cole Jackson, and the company that I have done my industry analysis slash firm valuation and forecasting model in or on is Nike. So, Nike is a global leader in the athletic footwear, apparel, and equipment industry, competing in a fast moving and highly competitive space. Since its founding in 1964, the brand has built a strong reputation for innovation, powerful marketing, and a direct to consumer strategy. Headquartered in Beaverton, Oregon, Nike is a household name across all global markets. Their entire manufacturing process is outsourced to over 500 independent factories, mostly in Vietnam, Indonesia, and China, which together account for over 90% of its supply. This global setup helps keep costs low and operations flexible, but it also makes Nike highly sensitive to international trade policy. So, as we know, in 2025, these new tariffs that the US has been putting on different Asian imports hit Nike very hard, triggering a sharp drop in its stock price and highlighting just how exposed the company is to shifts in trade and geopolitics. So, that said, uh, in my model, I assume the worst tariff related pressure is now behind us. And while there may still be some cost drag, I don't expect major new disruptions. So, financially, moving on, Nike has been on solid ground. The company's balance sheet is strong with low debt levels and healthy free cash flow, especially compared to some of its more leveraged competitors. So during the pandemic, Nike boosted its liquidity, increasing its cash reserves to over 13 billion in 2020, which helped weather supply chain volatility. So still recent performance reflects the industry's tougher landscape. After a strong post-COVID rebound, Nike's revenue dipped by nearly 7% in 2023, driven by supply chain hiccups, inventory challenges, etc. So in setting my revenue assumptions, I've taken a cautious stance. I'm assuming a 2% annual growth rate, balancing the company's long track record of resilience with the more tempered expectations we're seeing across the industry as a whole. So, lastly, Nike's premium brand position does justify it having a stronger valuation multiple compared to its peers. Its low leverage and solid fundamentals both support an EBITDA multiple approach and a perpetuity based terminal value in my model. So, just keep that in mind moving forward. And here's some of those growth ratios as well. So these go along with my forecasting assumptions. They are mainly what is grounded on my forecasting assumptions. So I've taken a conservative approach in grounding the recent industry trend in grounded in the recent industry trends. While Nike saw a strong rebounded strongly in 2021, its growth has since plateaued. Given this trajectory, my assumption is that Nike is entering a slower growth environment shaped by market saturation, some shifting consumer habits, and broader economic trends that they aren't really in control of. Anyways, this result, I've been assuming that the decline in the first 2 years of my forecasting model will then reverse into modest growth the years following those first 2 years. So additionally, I've also factored in the impacts of tariffs. While these have been a major headwind in recent times, my assumption is again that the worst of the tariff situation is behind us. So with no major new escalations expected, I believe the direct impact on Nike's top line will be limited going forward. However, I am still accounting for some lingering effects from prior cost increases and supply chain adjustments. Together, these factors do justify my cautious stance. The revenue growth assumptions in my model reflect this stable environment where my aggressive rebounds are unlikely and incremental progress is mostly it's the most reasonable base case. So my assumptions for margins follow suit. Um, assuming that there will be some higher than average increases in COGS in the last few years, with the years following the near future leveling back out to relatively consistent. That's how I've sort of modeled it in the near future. So Nike has always outperformed the industry, and I have yet to find anything to suggest that the future will deviate much from that pattern as far as margins and revenue growth are concerned. So moving on to the sensitivity analysis, and then this is the industry standing of Nike, and this is also some of the basis for my assumptions. But moving on to the sensitivity analysis, um, this highlights the most impactful assumptions steering Nike's valuation in my model. Accounts payable days stand out as the most influential. Shifting them by a mere 3% causes the largest change in cash per share of all of these factors, reflecting how working capital efficiency affects cash flow. And the EBITDA margin and sales growth are also major levers. Small changes here significantly impacted the value. On the other hand, capex growth is not a significant driver in my model, as shown by the minimal impact on cash per share in this analysis. Another 3% change in capex results in only a very small shift in valuation, especially when compared to drivers like sales growth and EBITDA margin. This suggests that Nike's long term capital investments are relatively stable and less volatile. Again, it looks like they're kind of keeping up with depreciation a little bit, and small adjustments to capex assumptions don't materially change this firm's, well, Nike's cash generation or enterprise values very much. So, because of this, I've modeled capex conservatively. I don't treat it as a core lever in the valuation, and I really do see it more as a maintenance strategy as far as Nike is concerned, especially with how volatile the markets have been over the last few years. So, moving on to how I calculated my RA. So, in my forecast model, I calculated RA, which is obviously the required return on assets, by blending Nike's cost of equity and cost of debt based on its historical capital structure. So, since Nike has pretty low leverage and a conservative balance sheet, I assume that the capital structure would stay roughly the same going forward. It's been fairly consistent over the last few decades. Nike is a very old company and they haven't switched up very much on that front. So there's nothing there that would suggest that the debt ratio would change very much in the near future. So that means that the equity portion carries a little bit more weight in the overall mix. So RA ends up being pretty close to the cost of equity. This rate represents the return required by both debt and equity investors before taxes or any effects of financial leverage. And by the rate, I am talking about RA, and I use it as a discount unlevered free cash flows in my DCF. Or I use it to discount those free cash flows, and I base these assumptions on Nike's stable track record, as I mentioned before, and their solid fundamentals, and I'm aiming to keep it more realistic and conservative, especially with the recent volatility in the markets. So, moving on again to the growing perpetuity method. So, in my forecasting model, I first used a growing perpetuity method to estimate Nike's terminal value and ultimately calculated an unlevered firm value of 93.7 billion. So after accounting for debt and cash, this translated to a market cap equity value of around 93.6 billion. So what stood out to me here was how closely this matched the actual market valuation according to Yahoo Finance. Nike's firm value is reported at 94.3 billion and market cap at 92.7 billion. And I was genuinely surprised by how much this model aligned with the real world data. It's about within a billion, and especially considering how conservative all my assumptions have been throughout my model, that gave me a lot more confidence that my valuation framework is more realistic and well grounded than possibly a little bit less conservative model assumption might have been. So moving on to the EBITDA multiple, based on my forecasts, Nike's 2029 EBITDA is projected to be around 14 billion, assuming a 25% EBITDA margin on 56 billion in revenue. So drawing from industry comps like Lululemon, Deckers, Crocs, some other footwear and apparel slash equipment firms that are very comparable to Nike, I selected an 11.5% EBITDA multiple, which is conservative, but it is grounded in Nike's brand strength and scale. This yielded a terminal value of 161 billion, and to make this value directly comparable to my previous growing perpetuity method calculation, I discounted it back to present value using an 8.5% required return on assets, which we also calculated before, just spoke about how we calculated that RA. And that resulted in a net present value of 107.1 billion. So this is significantly higher than the 93.7 billion from firm value produced by my growing perpetuity method. And that difference was actually expected, or I did expect that. So the perpetuity approach is based on long-term cash flows and a conservative growth. Again, my assumptions all grounded in everything that has been happening in recent times, as well as, a little bit more weight on historical trends, while the EBITDA multiple method captures market sentiment and pricing a little bit more. So in fact, using this NPV from the EBITDA multiple and solving for the implied perpetual growth rate suggests that the market is actually pricing Nike with a long-term growth expectation closer to 4 to 4.5%. So this compared to the lower growth rate I use in my perpetuity model, it just shows the contrast between the two methods and highlights the difference between the intrinsic valuation and market-based pricing, which helps frame a reasonable valuation range for Nike. So finally, my verdict, hold. I think using my conservative assumptions, the growing perpetuity method gave me a firm value of 93.7 billion, which is very close to where the market is right now, but ignoring that for now, the EBITDA multiple method did come in at a higher value of 107.1 billion, but that just reflects more of market optimism and peer-driven valuation. Again, I suspect that many investors hold the same assumptions that I do, that the worst of the tariff situation is behind us and that Nike does have some good growth coming up here in the near future. And since the stock is trading somewhere in between those two outcomes, it seems fairly valued, not cheap enough to justify a strong buy, but not overpriced enough to sell either. With solid fundamentals and a stable brand, Nike looks like a reliable long term hold, just without a clear short term upside base on where things are standing right now. So, again, I recommend a hold for Nike, and I think that it is currently fairly valued. Thank you.